Thank you, Doug. And I would like to thank to the Chilean Central Bank for the kind invitation to participate in this panel. I'm glad that I can stay in touch with the Chilean colleagues, at least in this remote way via a video conference. And I'm always very much happy to see how many things we have in common, in spite of the big geographical difference, culture differences, etc. There are really many similarities among the two policy institutions, including the current mindset, I would say. Speaking about central bank transparency, of course, it has many aspects. It's transparency about objectives, the policy framework, forecasts, as well as the policy deliberations. And this is just a quick look at the different communication tools that we have at the Czech National Bank. Actually, the recent additions to our policy transparency have been more on the side of the policy process. For example, since last year, we have attributed minutes which provide not only votes of individual board members by names, but also the key arguments of individual board members. We have also switched from this year to a new generation of policy report. Before that, we had an inflation report, a kind of old style way of writing about monetary policy. And since this year, we've moved to a monetary policy report, which is more focused on what monetary policy is doing, why, and how is it helping to the economy. But today, we all agreed that we are going to focus on an element of central bank transparency, which is quite traditional for us because we've been publishing interest rate paths in numerical terms already since 2008. And even before that, since 2002, we had endogenous interest rates in our projections. And initially we were communicating them just verbally, but now it's like 13 years of open numerical communication. So I will speak about that. Please, next slide. There are a few reasons why to have forecasts with endogenous interest rates and why to publish the paths of interest rates. Of course, the first one, which is very fundamental, is that a forecast with endogenous rates always goes back to target, no matter what your starting point is. And this is helping you to anchor inflation expectations. You don't say to people that inflation is going to be out of the target forever. You tell them, okay, I start with inflation, which is either above or below target, but here, this is what I'm going to do, given the current state of knowledge, to bring inflation back to target. And this is a crucial part of a modern policy framework. I was quite disappointed to see that the major central banks, when they did their policy reviews, this aspect was not part of it. I think this is really very, very fundamental. Besides that, a model-based forecast based on a good FSUP tools, it gives you a forward-looking story and a guidance to policymakers, not just in terms of the direction of interest rates, but to some extent also the magnitude. Of course, with all the caveats, the future is extremely uncertain. If you make a kind of uncertainty band or a fan chart around the outlook, the band is usually extremely wide. But even so, it's useful to have such an outlook, and often our experience is such that it simply outperforms a backward-looking policy or a pure intuition of the policymakers, of course, including myself, and especially in the difficult periods. Here I provide one famous example from August 2008. a situation when inflation was actually well above our inflation target, which at that time was 3%. Inflation was running close to 7%. Due to a combination of many things, including tax changes, regulated price changes, shock to the global oil prices, some overheating also in the Czech economy. So it was a combination of things similar to the current situation. And most central banks were hiking interest rates at the time, including ourselves. We were going through a gradual tightening cycle. But already from early 2008, the forecast started to suggest that later in the year, we should actually start thinking about cutting rates rather than hiking. Because at that time we were quite certain about the temporary nature of the spike in inflation, and we were also aware of the ongoing slowdown in the economic activity, which was driven by the global slowdown after the subprime mortgage crisis in the US had started. And we actually delivered the first rate cut in August 2008 based on those forecasts. And it was even before the collapse of Lehman Brothers, at the time when ECB was still hiking rates. And many people were shocked by that. How can you cut rates with a 7% inflation, go in the opposite direction than the large neighbor, the European Central Bank, the Euro area? But with the benefit of hindsight, this was an example of a good forward-looking policy. Next slide, please. The framework with endogenous rates also helped us to find out that we are a problem in November 2013, because we were going through a protracted recession, and there was an increasing risk of deflation in the Czech Republic. The forecast told us that basically if we didn't face the zero lower bound issue, we would need to cut the policy rate at least by 100 basis points to address those risks. But because we at that time did not want to go in the direction of negative interest rates, we had to search for an alternative unconventional monetary policy instrument, which in our case was a depreciation of the exchange rate combined with a public commitment to keep the exchange rate depreciated until we are back to the inflation target in a safe and robust way, and are able to start normalizing monetary policy again. And again, the forecasting tools helped us to calibrate properly this unconventional exchange rate instrument. And finally, on the next slide, I would like to speak about the recent COVID shock. Like in Chile, of course, COVID brought a massive contraction of economic activity also in the Czech Republic. And since then, we faced quite significant uncertainty about everything, including the pace of the economic recovery, including future evolution of inflation and appropriate monetary policy. So initially, once the shock hit, the forecasts were suggesting that we might face in the future quite significant disinflationary pressures due to the contraction of economic activity. So we cut rates very quickly. And then forecasts started to suggest quite a swift recovery, which actually happened, maybe a little bit faster even than what we were expecting. But one crucial thing, we were relatively correct about the GDP growth itself, but over time we had to reassess very significantly how the economic contraction was divided between output gap and potential output. We have learned over time that the shock was much more stagflationary. It was not a standard cyclical recession. So we actually did not see that much disinflation after the COVID recession. And once the economy started to revive, we actually see a sharp upswing in inflation, quite similar again to the Chilean experience and to the experience of many central banks. But I fully agree with Pablo on what he said. Even though much of the inflation spike is due to external reasons, it's a global phenomenon. We just cannot sit on our hands and do nothing. It's the job of monetary policy to anchor inflation expectations. And an important part of that is returning our monetary policy from extremely expansionary back to normal. And our forecasts actually have been suggesting the start of policy normalization around the middle of this year already, from the autumn forecast of 2020, from late last year. Initially, this was actually hard to believe to policymakers, including myself. And initially, we were quite heavily discounting this interest rate outlook in our public communication, pointing out to a lot of uncertainty regarding the COVID, the second, third, fourth wave of infections, etc. And we were communicating that in terms of the risk management approach, it was better for us to be a bit behind the curve in terms of policy normalization than to start a premature normalization, which I think was rational at that point of time. But once we have seen that the recovery is really ongoing and the country has made a lot of progress in terms of vaccination and also acquiring natural immunity, the situation is more or less back to normal way of thinking. And I think it's now good to acknowledge, at least to ourselves, to admit to ourselves that we are a bit behind the curve and we started to catch up with the policy normalization process that has been pictured in our forecast already for quite some time. And of course, the recent spike in inflation, it's an argument on top of that to not to wait too much with the process, but it's not the only reason. It was always part of our story that a forward-looking policy in mid-2021 will more or less be looking into 2022, a year that will hopefully be already quite normal in terms of the COVID situation. And we started to follow that policy guidance of our forecast. Actually, we had to accelerate even more recently. So it's very similar to the Chilean experience, and market has now bought this policy normalization story quite smoothly, I would say. So like in Chile, market now expects us to continue with interest rate hikes in a relatively swift manner for each and every of the upcoming policy meetings. So that's our experience. Thank you, and I pass the floor back to Doug.